Okay, let's unpack this. Plastic waste, it's a massive global challenge, right? And finding effective ways to recycle is just more important than ever.
Absolutely, especially PE plastic, the kind used in pretty much all beverage bottles.
Right. And in India, one company that's, well, deeply involved in tackling this is Ganesha Ecosphere Ltd.
Mm.
You sent us a stack of their recent documents. We're looking at their latest audited financial results for Q4 and the full financial year ending March 31st, 2025.
Yeah, plus their investor presentation and some other corporate filings too. Quite a bit of material.
Definitely. And our mission today is really to dive into these sources. We're going to pull out the key information, see what the numbers tell us, look at their operations.
Get a feel for the market they're in and figure out where they're planning to go next. Basically, cutting straight to what's most important in these documents for you.
Exactly. It's kind of your shortcut to being well-informed on this specific company and, this part of the recycling industry right now.
So we'll walk through the financials, touch on operations, get some market context, explore their strategy, all based directly on the material you provided.
Okay, so where should we start? The big picture.
Yeah, let's start there. The full financial year 2025 consolidated performance. This is straight from the highlights in that investor presentation you sent.
Got it. And these numbers, well, they really stand out. They're flagging them as first ever achievements for the company.
They are.
For the full year, EBITDA hit Rs 200 crore for the first time. That's a huge jump, 53% growth over FY24.
Yes, and profit after tax, PA, that also crossed a big milestone, exceeding Rs 100 crore.
Wow.
And the growth there is even more dramatic, a staggering 154% compared to the previous year.
Okay, 154% growth in PAT, that's massive.
Hmm.
Is that reflecting operational efficiencies, or is it mostly top-line growth driving that, or?
Well, it seems like it's probably a combination, but the top line growth was definitely a big factor, 31% growth in revenue, hitting Rs 1465 crore. And production volume was also up 20%, reaching 1.56 lakh tons. So yeah, undeniably strong full-year results. Shows substantial growth pretty much across the board. Looks like a very successful FY25 overall.
Right, a picture of really robust growth for the full year. But digging into just the most recent quarter, Q4 FY25, kind of in isolation, I noticed the numbers looked a bit different compared to Q3.
That's right, yeah. If you look at the consolidated quarter-on-quarter figures, so Q4 FY25 versus Q3 FY25, there was a bit of moderation.
Okay.
Revenue stepped down a bit from roughly Rs 398 crore in Q3 to about Rs 344 crore in Q4.
And EBIT also saw a slight dip, didn't it? From, 56.5 crore down to 51.1 crore?
Correct. Though interestingly, the EBITDA margin actually ticked up slightly. It went from 14.2% in Q3 to 14.8% in Q4.
No, interesting.
But PD, that decreased from about Rs 30 crore to around Rs 24 crore. And sales volume also moderated quite a bit, dropped from nearly 30,000 metric tons in Q3 down to about 23,500 in Q4.
Okay, so a clear moderation compared to the immediately preceding quarter. But how does it look compared to the same quarter last year? Q4 FY25 versus Q4 FY24, still showing growth there.
Yes, exactly. Year on year for the quarter, the picture is still growth. Revenue grew from about Rs 306 crore to Rs 344 crore.
Okay.
EBITDA was up from Rs 47 crore to Rs 51 crore. PAT grew too from about Rs 21.6 crore to Rs 23.8 crore.
Right, but the sales volume was slightly down year on year as well, similar to the Q2 trend.
Yeah, slightly down year on year too, from about 27,500 MT to 23,500 MT.
Okay, so overall growth year on year for the quarter, but definitely a step back compared to Q3. What's driving that recent quarterly dip? Does the presentation give any clues?
It does, yeah. The investor presentation highlights point to some specific challenges they face in Q4. A major one was the soaring price of raw bottle scrap. That's their main raw material.
Huh?
Apparently, it hit an all-time high during that quarter. The good news, they say, is that prices started to cool off in May 2025.
Okay, well, that makes sense. Skyrocketing raw material costs would definitely squeeze things. Could explain lower sales volume, too, if they were, managing inventory or facing issues getting enough scrap.
Exactly. They also mentioned continued margin pressure in their RPSF business, that's recycled polyester staple fiber. Seems there was depressed demand there.
Right.
And on top of that, higher food grade prices, which probably influence either raw material costs or maybe competing products, added to the cost pressure for RPSF. Plus, they note the sales volume for rPET granules also moderated. Apparently, the price gap with virgin material widened in Q4, making their recycled product less competitive just on price during that specific period.
Okay.
So you put all those factors together, and it seems to explain that moderation we see in the Q4 numbers compared to Q3.
Got it. Now, the documents you sent, they break things down into both standalone and consolidated results. For someone less familiar, what's the quick difference there and why is it worth noting?
Good point. So, standalone typically represents the core, maybe older business operations. Consolidated results, they include the performance of the subsidiary companies as well,
Right.
which in Ganesha Ecosphere's case, according to the presentation, includes things like the newer Warangal facility and their Nepal operations.
So consolidated gives you the total picture,
Yeah.
the whole group. And looking at the Q4 FY25 numbers, yeah, standalone revenue was what? Aria's 216 crore and Paytee was Aria's 14.7 crore, noticeably lower than consolidated, like you'd expect.
Right. And there's a really key highlight in the presentation that shows how important the subsidiaries are becoming.
Oh, yeah.
The EBITDA contribution breakdown for Q4, it shows about R's 21 crore came from the legacy business. That's probably the standalone part. But a larger amount, over R's 30 crore, came from the subsidiary businesses.
Wow. Okay. So that split really shows the newer ventures are becoming major contributors to the bottom line already.
Exactly. It signals a pretty significant shift in where the growth and profitability are coming from within the group.
Sure. That's really interesting. Okay, let's dig into the detailed financial statements themselves. The P&L, balance sheet, cash flow, which were also in the documents you sent. Beyond the headlines, what kind of things stood out there?
Well, on the P&L side, looking at expenses for the full year, FY25 versus FY24,
Yeah.
the cost of materials consumed saw a really significant jump in the consolidated results.
Right, which ties back to that raw material price story.
Precisely. It was less pronounced in standalone, but still up. This definitely reflects that raw material pressure, especially impacting the consolidated group with its newer facilities online.
Okay.
Employee benefits expense was also up year on year, both standalone and consolidated. That's kind of expected with expansion, maybe higher headcount.
Sure. And finance costs. I noticed an interesting trend there. Consolidated finance costs increased quite a bit year on year for FY25, while standalone finance costs actually decreased. That difference really hints at how the group's expansion is being financed, doesn't it? Maybe leveraging debt more heavily at the consolidated or subsidiary level?
That's a great observation. It strongly suggests that. Now, moving to the balance sheet, comparing the end of FY25 to FY24, the story of expansion is, well, crystal clear. Huge increases in assets.
Yeah.
Property, plant, and equipment is up significantly, especially on the consolidated side. Jumped from around R's 770 crore to over R's 915 crore.
Okay, wow. And the standalone balance sheet, that showed investments in subsidiaries surging, right? From like R's 154 up to R's 354 crore.
Exactly. And other non-current assets also saw a big increase in both consolidated and standalone reports. It really looks like a lot of capital being poured into growing the business, building things out.
It absolutely does. So what about the other side, liabilities?
Well, there's a very notable increase in short-term borrowings. Consolidated short-term borrowings jumped massively from about R's 27 crore to nearly R's 188 crore.
Wow.
And standalone went from almost nothing, like half a crore, up to R's 106 crore. Long-term borrowings were relatively stable on the consolidated view, but actually decreased standalone. And total equity naturally increased, due to profits and some capital they raised earlier.
Okay, so substantial increase in assets, funded in part by a significant jump in borrowing, particularly short-term. What does this balance sheet picture, especially that borrowing increase alongside the asset growth, tell us about the company's current stage?
It paints a really clear picture, I think. This is a company in a heavy investment phase, and it's actively financing that growth.
Right.
The big jump in property and equipment, coupled with those increased investments pouring into subsidiaries, it's directly correlated with the increase in borrowings. They're leveraging up, particularly in the near term, to fund this expansion.
Makes sense.
It's a common approach during big growth cycles, but yeah, it's definitely a key dynamic revealed by these statements. Managing that debt load becomes important.
In the cash flow statement you included, consolidated cash flow from operating activities for FY25 was around Rs 41 crore. Pretty stable compared to FY24, even with a higher revenue.
Yeah, relatively stable operating cash generation. But cash flow used in investing activities, That was substantial, just like the balance sheet suggests. It was over Rs 125 crore outflow for FY25 consolidated.
Okay.
And this is where you see the money going out for, property, plant, equipment, and those big investments in subsidiaries. The standalone cash flow even explicitly shows a Rs 200 crore outflow just for investment in subsidiaries. That's a huge chunk of cash deployment right there.
And cash flow from financing activities was positive, about Rs 157 crore in FY25 consolidated.
Right. That was largely driven by receiving funds from borrowings, like we saw on the balance sheet, and also equity raises they did earlier, like warrants being converted and a QIP.
Okay.
They also paid out a dividend, about Rs 11 crore consolidated for FY25.
So these cash flow movements really just confirm what the balance sheet implies then.
Absolutely. Cash generation from the core operations is stable, but they're spending significant amounts on investing activities to expand. And this investment is primarily being funded by bringing in money through borrowings and proceeds from past share issuances. It's definitely a company in active CapEx mode.
Got it. Okay, so beyond the core financials, the filings you sent mention a few other corporate actions too.
Yes, a notable one is the board recommending a final dividend, Rs 3.00 per share for FY25.
Okay.
That's a 30% dividend on the Rs 10 face value shares, but it's pending shareholder approval, of course.
Right. They also reported allotting about 110,000 equity shares right at the end of the financial year, March 31st. That was from warrants being converted, right? Which increased the paid-up capital slightly.
Correct. And there's also a mention of them investing just under Rs 3 crore into a new joint venture company. It's called Ganesha Recycling Chain Private Limited.
A JV. With who?
With a company called Race Eco Chain Limited. Looks like it was incorporated back in September 2024.
Interesting. The filings also included details on the monitoring agency reports. These relate to how they used the money from previous fundraisers, like the preferential issue and the QIP, right, for Q4 FY25.
Exactly. And the documents state that the audit committee and the board reviewed these reports with no comments.
Which basically means?
Which essentially means they're staying compliant, they're reporting properly on how they're using the capital they previously raised from investors. It's a standard check, a bit of governance paperwork for companies that raise funds through those routes.
Okay, good to know. So we've gone through the recent numbers, the corporate steps. Let's maybe zoom out a bit now and talk about the business itself in the broader industry context. The presentation covers this too, right?
It does.
Ganesha Ecosphere positions itself as, well, a leading PET plastic recycling company in India, over 3 decades of experience.
Yeah, they really highlight their scale. 6 facilities now. Total recycling and washing capacity is stated at 196,440 metric tons per annum. That's quite large. And a big customer base, over 400 across more than 20 countries. And they source their raw material, the waste PT bottles, from a network of over 300 suppliers across India.
And their mission statement seems pretty clear, very aligned with the sector. Recycle every PT bottle, create wealth for stakeholders, make the planet better.
Standard stuff, but important. And their core process is basically taking those waste PT bottles and turning them into value-added recycled products. Things like RPSF, RPT granules, and RPT filament yarn.
You mentioned capacity utilization earlier. The documents pointed out their standalone business was running really high, 99%.
Almost flat out.
But the newer Warringal business, part of the subsidiaries, was lower at 63%.
Right. And that difference in utilization is quite telling. 99% suggests the older, maybe more established facilities are running at full tilt. The lower 63% at Warringal, which is where a lot of the recent investment has gone, that likely means that facility is still ramping up or maybe has recently brought new capacity online that isn't yet fully absorbed or utilized.
Or perhaps tied back to those Q4 operational challenges.
Exactly. High raw material prices, margin pressure. Those things can definitely impact utilization if it's just not economically viable to run at full steam for a period.
Right. So speaking of the broader context, why is PT recycling such a critical area right now, especially in India?
The documents give really good perspective on this. First, the India PET market itself is just substantial. Expected consumption is 15 lakh tons in calendar year 2025.
Huge market.
But the real fuel, the big driver for the recycling sector specifically, is government policy. India's Extended Producer Responsibility Rules, or EPR.
Ah, yes, EPR. We hear a lot about that. How does it apply here?
Well, these EPR rules are creating a significant regulatory push, particularly for rigid plastics like PET bottles. There are now mandatory recycled content use
The
targets.
mandatory targets like what?
For PET bottles, it's 30% recycled content required by FY26, and that jumps substantially, up to 60% by FY29.
60%. Wow.
Yeah. Plus, there are overall recycling targets for producers and also reuse targets.
Okay, so this is massive for a company like Ganesha Ecosphere, isn't it?
It's huge. These regulations aren't just encouraging recycling, they're mandating demand for recycled PE content.
Right.
The presentation project's rapidly rising RPE demand because of this. They're forecasting something like 3.5 to 4 lakh tons needed in FY26 alone. That's the kind of market pull that really supports significant investment.
It really sounds like the government is essentially creating a guaranteed or at least heavily supported market for companies producing recycled PET. But does that kind of aggressive regulatory push potentially create challenges too? Like maybe putting even more pressure on getting enough raw bottle scrap, which we saw was already an issue in Q4.
That's a really crucial point, and I think the documents highlight it indirectly through those Q4 results. Yes, the EPR targets create demand for the finished product, recycled pellets or fibers, but they also intensify the competition for the raw material, the waste PET bottles themselves. As more players gear up to meet these mandatory targets, the supply of collected scrap becomes more constrained.
Ah, right. Supply and demand.
Exactly. Which can lead to price volatility, like those record highs they apparently saw in Q4. So while EPR is definitely a huge tailwind for demand, managing that raw material supply chain effectively and handling the price risk becomes absolutely paramount for recyclers like Ganesha.
Makes sense. Okay, so beyond regulation, the sources list some other drivers for recycled PC too.
Right. They mention things like increasing adoption of RPT by big brands just looking to reduce reliance on virgin plastic for their own sustainability goals.
Sure.
Innovations in recycling tech are making RPT better quality, more versatile. There's rising consumer and brand demand generally for sustainable packaging.
Yeah, you see that everywhere.
And importantly, the increasing number of defined standards and certifications. Bodies like FSSAI in India, FDA in the US, EFSA in Europe. Having those approvals builds confidence and even enables RPT use in food contact applications, which is a big deal.
Okay, so that global and regulatory push combined with improving tech sounds like a pretty strong market environment for them overall, and the company naturally highlights its key strengths in this environment.
Of course. They list being an early mover in India's B2B RPET granules space, which gives them a leading position, they feel. They emphasize their deep domain expertise, 30 plus years in the game.
Right.
Their expanding product portfolio, especially under this new GoreWise brand, strategically located facilities, state-of-the-art apparently, and experienced management.
And this GoreWise brand, it seems pretty central to their forward strategy. What's the focus there?
Yeah, GoreWise is presented as their move into, quote, next-generation recycling. It's all about focusing on higher value-added, more sustainable products.
Right. What specifically?
This includes things like bottle-grade RPD chips that have major international and Indian food contact approvals, US FDA, EFSA, FSSAI, also textile-grade RPD chips, and various RPD fibers and yarns that have global textile certifications like GRS and Ocotex.
Right.
So they're clearly targeting customers in demanding sectors like food and beverage and textiles, companies that have their own strong sustainability mandates to meet.
And their strategic realignment goal, mentioned in the documents, is to significantly boost the revenue contribution from these higher margin value-added products, right?
Yeah.
To around 65% of total revenue, up from the current 40%.
That's the target. It's a substantial planned shift in their product mix ambition.
Which I assume directly ties into the massive capacity expansion plans detailed in the presentation.
Exactly. That shift towards higher value products requires more capacity for those specific products, particularly the RPE granules.
And the CapEx figure is really striking planned investment of approximately INR 725 crore. Just for RPT granules expansion.
It's huge. And that's broken down into a significant chunk, INR 600 crore, for a brand new greenfield facility in Odisha.
Wow.
And another INR 125 crore for a brownfield expansion, adding capacity at their existing Warangal plant.
And the planned capacity additions themselves are equally impressive. What were the numbers? 67,500 metric tons per annum of RPE granules in Odisha.
Expected by the first half of FY27.
Yeah, and another 22,500 MTPA at Warangal by Q4 FY26. So that's a total of 90,000 MTPA of new capacity, all focused on RP
No,
granules.
they are clearly betting big on the RPE granules market, especially the bottle grade segment. This scale of investment, this capacity addition, it directly reflects their ambition to meet that projected surge in RPE demand we talked about, driven by EPR.
Right.
And also to capitalize on the potentially higher margins these value-added products offer compared to their traditional RPSF business.
Makes sense. What other strategic focuses do they mention? Anything else jump out?
Well, they talk about strengthening their overseas presence, aggressively pursuing that bottle grade demand globally, not just in India,
Right.
capitalizing on the favorable regulations here, obviously, increasing their market share in technical and household textiles. And interestingly, they mention working directly with over 40 brands on getting their products approved. That sounds like embedding themselves in customer supply chains to help those brands meet their own sustainability targets.
That's smart. And their environmental commitments. They seem pretty integrated into the strategy, too.
Absolutely. They highlight their contribution to reducing the waste burden, creating a circular economy. They mention significant investment in solar power, 16.5 millipower of rooftop capacity installed,
Nice.
and water recycling initiatives, a zero liquid discharge facility, and recycling around 90% of water used at the Warangal plant. These points definitely reinforce their sustainability credentials, which aligns well with their overall business model and market positioning.
Okay. So bringing this all together then, for you, the listener who provided these documents, what are the sort of key takeaways from this deep dive into Ganesha Ecosphere's recent performance and plans?
Well, first, I'd say Ganesha Ecosphere had a very strong financial year overall in FY25. They hit some record milestones in profitability and growth, showing the underlying business strength.
Right. But second, the most recent quarter, Q4 FY25, it did see some moderation compared to Q3, influenced by some pretty challenging factors like those surging raw material prices and margin pressures in certain segments, like RPSF.
Third, the financials make it crystal clear. The company is in a substantial investment phase. They're leveraging significant capital, partly through increased borrowings, to fund really ambitious capacity expansion, especially in that high-margin RPE granule space.
Okay. And fourth, this expansion is strategically aligned, isn't it, with that massive projected growth in RPE demand, which is significantly driven by India's EPR regulations and also growing brand demand for sustainable materials.
Exactly. And finally, maybe fifth, they are actively trying to reposition their product mix towards these higher value-added items under their Gorewise brand, and they're working closely with customers to capture this regulatory and market-driven opportunity.
So we've really peeled back the layers here on the financials, the operations, market context, strategic direction, all reviewed in these documents you sent. For someone interested in understanding a company right at the forefront of India's recycling sector and seeing how regulations are directly fueling business growth, this snapshot of Ganesha Ecosphere is, well, incredibly insightful, I think.
Yeah, it shows a company that's performed well recently is definitely navigating some near-term cost pressures, but is making really big strategic bets on the future growth of recycled PT.
So given the sheer scale of that planned expansion, that 90,000 tons of new capacity, and the inherent volatility in raw material prices that they just experienced quite sharply in Q4, here's maybe something to consider, a final thought. How effectively can Ganesha Ecosphere not only execute on building out the significant new capacity on time and on budget, but also, crucially, secure the necessary raw material supply consistently and navigate those fluctuating market prices for scrap, all while ensuring that demand for their essentially doubled capacity keeps pace with the rapidly evolving regulatory landscape and market dynamics over the next few years? That feels like the critical question the next phase will really answer.